Morning, we're here to talk about the quarterly market review, first quarter 2022. Now we all came into 2022 hoping that perhaps the world would get a little bit simpler, a little less complicated, but it hasn't. There's been a lot going on in the world. I've got Dr. Steve Garth with me here today to help us digest this and talk about what's going on. Welcome, Steve.
Yeah, thank you, Nigel.
So some of the key themes, Steve, were we've had the war in Ukraine, which is really sad to see. We've had inflation, interest rates. I mean, overall, markets, or most portfolios are still performing very well, but one of the key concerns for investors is what's going to happen next.
So let me start off by talking about how the Australian market performed in the last quarter, because what you mentioned, inflation, interest rates and the war in Ukraine all played into that. And you can see in the chart we've got up at the moment, Nigel, how right at the very start of the quarter, the market came off, and that was on the fear of rising inflation and rising interest rates. So mainly tech stocks got hit. And then you can see the market recover a little bit, but then towards the end of February, that's when the Russian troops went into Ukraine, and that caused a great deal of uncertainty, and you see the market wobble down again. Then on March the 16th, the US Federal Reserve did put up interest rates by 0.25%, and even though rising rates was widely feared, when the rates actually went up, the market said, actually, the economy's in pretty good shape, and the market both here in Australia and in other markets continued to go up. So quite a roller coaster of a ride in Australia, but the Australian market has finished 2.2% positive for the quarter. Although not so when we go globally, and there's reasons for this. Australia has sort of defied gravity. If you look at this chart, Australia is positive, but the other markets are negative. And the reason for this is that Australia is, sort of everyone knows, main sectors here are banks and mining. So banks do well when interest rates go up or interest rates are expected to go up. And mining does well because there's a commodity boom going on at the moment. So the Australian market does really well in these conditions. Other markets though, take the US where it's very heavily into tech stocks, you know, the Apple, Googles and Netflix are all there. They're the stocks that really got whacked over the quarter. So you can see that the international markets are negative, and of course Europe is right in the middle, if you like, of the conflict in the Ukraine. So Australia a positive quarter, negative quarter for other markets, but for the 1 year return that we've got there, that's really good. You know, markets are still up, 12-15% over 12 months.
Now, Steve, one of the key components of our investment philosophy is to stay well diversified, and part of that approach is we have exposure to cash and bonds. And bonds have served clients well for a long, long period. The last time we've had negative returns is 1994. But this quarter hasn't been too good for bonds. So do we get out of bonds? What should we be doing?
Yeah, it's a great question, Nigel. You're absolutely right. It's a bad quarter for bonds. In fact, it's the worst quarter on record. So it beats 1994. So we should say that it's rare that bonds have a negative return, but it does happen from time to time. Why has it happened this time? It's got to do with expectations around inflation and interest rates. So the bond yields price in the expectations of future interest rate rises. And you can see on the chart here, the line there is the bond yield. Now, normally we wouldn't show bond yields, it's a little bit esoteric, but the yields going up means that bond prices go down, and you can see that in the chart of quarterly returns underneath with those two big negatives in the last 6 months. Now, we all know that interest rates are going to go up, so should we expect bond prices to keep going down? Actually, the answer is we don't know what the bond prices will do. What we do know is the market's fully priced in its expectations around future interest rates and future inflation. When interest rates do go up, that by itself won't change the return on the bonds. It'll be the expectations around the future that will affect the bond return.
Yeah, thanks, Steve. I think it's important from our investment philosophy point of view is that while we challenge it, what we do know, and I think this was a quote from Jack Bogle, the founder of Vanguard, he said there might be a better investment philosophy out there, but there's an infinity worse.
Yes, that's right. That's a good point.
For our clients, it is constantly looking at what we're doing. That's why you're involved in the team as well. How can we improve these things? But we will not drastically make big calls quarter to quarter, despite what's going on in the past quarter. Because as you said, even though bonds had the worst quarter in this quarter or the previous quarter, could be the best quarter next quarter. And so those knee-jerk reactions are not something that we all sort of recommend.
That's right, Nigel. As you well know, it's not timing the market it's the time in the market that pays off.
Well, Steve, thank you so much again for your time. I hope the clients, the last video was our most watched and most engaged ever, and we've been producing videos now for a couple of years, so thanks so much. I think this is very helpful, and hopefully for the clients watching, please ask if there's any questions.
Thanks, Nigel.